August 15, 1971. Most people think of this date as a history lesson, a detail in a textbook about Nixon and gold. They are wrong. That was the day the global economy stopped operating on mathematics and started operating on faith. In that singular moment, money ceased to be an asset, something you own, and it became a liability, something you owe. For 50 years, that faith held. Governments borrowed, economies grew, and the debt piled up in the background, silent and invisible. The debt doesn't matter, the economists told you. We owe it to ourselves. But today, the math broke. We are staring at a number that defies human comprehension. $110 and $10 trillion. Let me put that number in perspective. If you stacked $100 trillion in $100 bills, it wouldn't just reach the moon. It would form a highway to the moon and back 300 times. But the number isn't the scary part. The velocity is the scary part. In the first half of 2025 alone, the world added $21 trillion of new debt. That is a vertical line. We are adding debt faster than we can print the money to pay for it. But here is the detail the news anchors miss. It's not just about how much we are borrowing. It is about why we are borrowing. In the 20th century, when a government borrowed $1 billion, they built the Hoover Dam. They built the interstate highway system. They built assets that generated cash flow for 50 years. Today, we are not building dams. The debt accumulation of the 2020s is characterized by what Hyman Insky called Ponzi finance. We are borrowing simply to fund entitlement programs and to pay the interest on the old debt. It is non-productive. It is dead weight. When you borrow just to keep the lights on, you aren't investing. You are liquidating. Now, I'm going to tell you a secret. That number, the 100 trillion, it doesn't actually scare me. We can print 100 trillion. We can fake it. We can ignore it. The number that keeps me awake at night is the cost of servicing it. Welcome to the interest expense singularity. In 2025, the United States government will spend approximately $970 billion purely on net interest payments. Let that sink in. That is more than the government spends on children. It is more than they spend on veterans. It is more than the entire national defense budget. Do you understand the gravity of that? Economists call this crowding out. Every dollar of tax you pay is now spoken for before it even leaves your paycheck. Entitlements consume the first half. Interest consumes the rest. That means there is mathematically zero discretionary budget left. No money for the grid, no money for infrastructure, no money for the future. Your taxes are no longer building a country. They are simply paying for the mistakes of the past. Think about that. The greatest military superpower in the history of the human species now spends more on paying off bondholders than it spends on its own army. The U.S. government has transformed. It is no longer a sovereign nation. It is a giant insurance company with an army that is slowly being forced to sell the army to pay the insurance premiums. This brings us to the concept that kills empires. Historians call it Ferguson's Law. Niall Ferguson famously noted that if you look at the Habsburgs, the Bourbons, the Romanovs, the Ottomans, the British Empire, the end always begins the same way. It begins when the cost of servicing the debt exceeds the cost of defense. When you pay more to the bankers than you do to your soldiers, you are no longer a superpower. You are a distressed asset. And once you become a distressed asset, you face the fiscal cliff. Imagine a pilot realizing he is running out of fuel. The government has two choices, just two. Option A, default. Tell the bondholders they aren't getting paid. The market crashes. The banks fail. Depression. Option B, print. Print the money to pay the debt. Inflation explodes. The currency dies. Revolution. They are trying to find a third door, but the math is broken. The media is talking about a soft landing. There is no soft landing when the pilot is dead at the wheel. So, if the math is broken, why hasn't it collapsed yet? Because of the rollover. Because as long as they can find someone to buy new debt to pay off the old debt, the music keeps playing. But the music is about to stop. So, Ferguson's Law is the diagnosis. But to survive what's coming, you need to understand the mechanism. You need to understand exactly how the patient dies. It doesn't happen in the stock market. It happens in the plumbing. Sovereign nations are different from you and me in one critical way. They never pay principal. When a 10-year bond matures, the government doesn't write a check to pay it off. They issue a new 10-year bond to pay for the old one. In the industry, we call this rolling the debt. In any other industry, the FBI calls it a Ponzi scheme. And here is the trap. For 15 years, we rolled the debt at 0%. It was free. But now, we are rolling trillions of dollars of free debt into debt that costs 5%. We are refinancing a zero-interest mortgage into a subprime nightmare. Look at the maturity wall. According to the latest Treasury data, precisely 33% of all outstanding U.S. marketable debt matures in less than 12 months. 33%. That is roughly $9 trillion. Do you understand what that means? Before the U.S. government spends a single penny on the military or Social Security or keeping the lights on, it must find buyers for $9 trillion of bonds just to stay exactly where we are right now, just to tread water. And this is where the auction comes in. Most people think the price of money is set by the Fed chairman waving a wand. Wrong. The price of money is set at 1 p.m. Eastern Standard Time in a quiet digital auction that determines the fate of the global economy. Imagine a room, no screaming traders, just algorithms and silence. The Treasury offers debt. The primary dealers, the big banks like J.P. Morgan and Goldman, they bid on it. Ideally, the demand is high, the auction clears, the system hums. But recently, the system has started to cough. I want you to learn a new term. It is the most dangerous word in finance right now. The tail. The tail is the difference between what the market thought the debt was worth and the price the Treasury actually had to accept to sell it. If the tail is 0, everything is fine. But if the tail is positive, even by a fraction, it means the buyers went on strike. It means the Treasury had to get on its knees and offer a discount just to get the junk off their books. It is the smell of desperation. In late 2024 and throughout 2025, we started seeing tails of 2, 3, even 5 basis points. That sounds small. It isn't. In the bond market, a 5 basis point tail is a heart attack. It is the market screaming, "We don't want this paper anymore." And why don't they want it? Because the reliable buyers are gone. The Federal Reserve, they aren't buying. They are selling. It's called quantitative tightening. China, they aren't buying. They are liquidating to prop up their dying currency. Japan, they're gone too. So who is left? Hedge funds, mercenaries, people who don't buy for safety, they buy for profit. And when you rely on mercenaries to fund your government, the price of protection goes up rapidly. This is the rollover crisis. It's not a possibility. It is a mathematical certainty locked into the calendar for the next 18 months. The auction fails. The yields spike. The interest expense explodes. And the margin call is triggered. But a crime scene isn't just about the weapon. It's about the suspects. We have 3 main actors in this tragedy. 3 economies holding hands and jumping off the cliff together. You think the U.S. is the sickest patient in the hospital? Wait until you see what's hiding in the books in Beijing. So, we have established the mechanism, the auction, the tail, the rot. Now, let's look at the patients. The global economy is effectively a suicide pact between 3 specific entities: the United States, China, and Japan. If one falls, they all fall, but they are dying of very different diseases. Suspect number 1, the United States, the safe haven, the reserve currency, the $38 trillion Leviathan. We all know the U.S. is sick. It's not a secret. It's a reality show. You can see the debt clock on a billboard in Times Square. But the diagnosis has changed. For decades, the U.S. was just irresponsible. Now, it is terminal. J.P. Morgan CEO Jamie Dimon recently said it plainly. We are driving 60 miles an hour toward a cliff. He isn't talking about a recession. He is talking about the fiscal cliff. What does that cliff look like? It looks like a government that has lost its fiscal flexibility. When the 2008 crisis hit, the U.S. debt was 60% of GDP. They had room to print. They had room to borrow. Today, it is 125%. The credit card is maxed out. If we have another crisis, a war, a pandemic, a banking collapse, the U.S. cannot borrow its way out. The tank is empty. But the U.S. is the loud crisis. It's the drunk driver crashing the car while screaming out the window. I am far more terrified of the quiet crisis. Suspect number 2. If the U.S. is a tragedy of excess, China is a tragedy of lies. Official statistics say China's government debt is low, just 24% of GDP. That is a lie. To find the real debt, you have to dig into the shadows. You have to look at the LGFV. Local, government, financing, vehicles. This is the most dangerous acronym in global finance. Here is how the scam works. Local governments in China, cities, provinces, are not allowed to run deficits. Beijing says no borrowing. But Beijing also demands 5% GDP growth every year. So what does a local mayor do? He creates a shell company, an LGFV. The shell company borrows money from the banks. The shell company builds a bridge to nowhere, or an apartment complex no one lives in. The construction creates GDP. The mayor gets promoted. And the debt? It stays off the books, hidden. This is why you see videos of brand new skyscrapers in China being demolished. They weren't built to be lived in. They were built to be borrowed against. They are physical monuments to fraudulent collateral. Forensic estimates put this hidden debt between 8 and 14 trillion US dollars. That is half the size of the US economy, completely unregulated and completely insolvent. But here is the twist. The US is inflating its debt away. The prices go up. China is caught in a deflationary trap. In deflation, prices fall, wages fall, but the debt stays the same. That means the debt gets heavier every single day. And the collateral backing all those trillions in loans? Land. The LGFVs rely on selling land to pay the interest. But the Chinese property market has collapsed. Land sales have evaporated. The cash flow is zero. The black box is empty. Beijing is currently playing a game called Extend and Pretend. They are forcing banks to roll over these bad loans for 20 years. They are turning their banks into zombies to hide the truth. But you cannot hide $14 trillion forever, especially when you have a maturity wall of your own coming in 2026. So here is the picture. To the west, you have the United States, a junkie addicted to spending, facing an interest rate singularity. To the east, you have China, a fortress built on a foundation of shadow debt sinking into a deflationary sinkhole. Together, they account for the vast majority of global growth, and they are both functionally insolvent. But a crime requires more than just a motive. It requires a weapon. We have the debt, we have fraud, but what pulls the trigger? What turns this condition into a crash? To find the trigger, we have to look at the third suspect, the one nobody talks about, the silent assassin. Japan. And specifically, a trade that hedge funds have been using to milk the system for decades, a trade that is about to blow up in their faces. You think your portfolio is safe because you own solid American tech stocks? You have no idea how much of that value is propped up by cheap Japanese yen. In the next chapter, we are going to unravel the carry trade, and I will show you how a butterfly flapping its wings in Tokyo causes a hurricane on Wall Street. We have identified the victims: the United States, China. But a victim doesn't just die because they are sick. They die because something pushes them over the edge. In chaos theory, they call it the butterfly effect. In global finance, we call it the yen. Welcome to the carry trade. For 30 years, Japan has been the world's ATM. Here is the mechanism. It is beautifully simple. A hedge fund manager borrows money in Japanese yen. Why? Because the interest rate is zero. It is free money. He then converts that yen into dollars and buys something that actually pays a yield. U.S. Treasuries, Mexican pesos, or he speculates. You see, the carry trade isn't just about bonds. It is the fuel for everything. That Nvidia rally, funded by the yen. Bitcoin, funded by the yen. U.S. junk bonds, funded by the yen. The entire global asset bubble is floating on a sea of cheap Japanese liquor. But now, the bar is closing. The Bank of Japan is exiting yield curve control. They are normalizing rates. And when the price of the yen goes up, the trade reverses. Imagine you borrowed $1 million to buy stocks. Suddenly, the bank calls you. They don't just want the interest. They want the loan back. What do? You sell. You sell the Nvidia. You sell the Bitcoin. You sell the treasuries. You sell everything to pay back the yen. This is called a correlation of one. In a carry trade unwind, there are no safe assets. Everything is just source of liquidity to meet the margin call. But Japan is just the external trigger. The real dynamite is strapped to our own chest. Let's talk about the basis trade. If you want to know how the American bond market actually dies, don't look at the national debt clock. Look at a hedge fund like Citadel or Millennium. They run a strategy called the Treasury basis trade. It's an arbitrage. They buy the cash Treasury bond and they short the Treasury future. The price difference between them is tiny, fractions of a penny. So how do they make money? Leverage. 50 to 1, sometimes 100 to 1. They borrow massive amounts of cash in the repo market to supercharge these tiny returns. And this trade has become the backbone of the entire U.S. Treasury market. The government needs these hedge funds. Because the foreigners stopped buying, these leveraged gamblers are the only ones left soaking up the supply. But there is a catch. There is always a catch. This trade works perfectly as long as the market is calm. But if volatility spikes, if Japan raises rates, if there is a geopolitical shock, the repo banks get nervous. They increase the haircut. They demand more collateral. And suddenly, the hedge fund gets a margin call. To pay it, they have to sell the treasuries. Selling treasuries drives yields up. Rising yields cause more volatility. More volatility causes higher margin calls. It is a doom loop. We saw a preview of this in March 2020. The Treasury market, the safest market in the world, ceased to function. It froze. Why? Because the basis trade blew up. The Fed had to step in with trillions of dollars to bail them out. They became the dealer of last resort. But in 2020, inflation was zero. The Fed could print. In 2025, with inflation sticky and debt at 100 trillion, they cannot print. If the basis trade blows up today, there is no safety net. So here is the trigger mechanism for the crash. Step 1. Japan raises rates. The yen spikes. The carry trade unwinds. Step 2. Global liquidity dries up. Volatility hits the U.S. bond market. Step 3. The hedge funds in the basis trade get margin called. Step 4. They are forced to fire sale trillions in U.S. debt into a market with no buyers. Yields go vertical. The government becomes insolvent. The banking system freezes. It's not a theory. It's a Rube Goldberg machine of financial destruction. And the first domino has already been tipped in Tokyo. You might think, surely the government knows this. Surely they won't let it happen. They are the ones who built the machine. And if you want to know what happens when a G7 nation loses control of its bond market, we don't have to guess. We just have to look across the Atlantic to the United Kingdom and the bond massacre that served as the warning shot. So, you know the math. You know the mechanics. You know the trigger. The question is no longer will it happen. The question is where will you be when it does? In a burning building, the exit is usually marked. In the global economy, the exit is hidden. You have to understand the government's playbook. When the fiscal cliff arrives, they will not choose default. They will not choose austerity. They will choose inflation. They will try to burn the real value of the debt and your savings to keep the system alive. They will cap yields. They will seize capital. They will lock the doors. This is called financial repression. Your only defense is to step outside the system they control. You must own things that cannot be printed. Gold, the ancient ledger. It is the only asset that is no one else's liability. Bitcoin, the digital exit. The only asset that cannot be diluted by a central banker's keystroke. Land, productive earth. The architect in the safe room doesn't hold treasury bonds. He holds hard assets. He understands that when the currency dies, the only thing that matters is collateral. But it is not just about what you own. It is about where you own it. We are witnessing the great rotation. Capital is fleeing the old world, the debt-laden empires of the West, and the demographic deserts of the East. It is looking for geopolitical arbitrage. It is flowing to the New World, to demographic growth, to places like India and the Global South. While the West fights to pay its interest, the emerging world is fighting to build its future. The margin call is a transfer mechanism. It transfers wealth from the passive to the prepared, from the holders of paper to the owners of reality. The system will try to sacrifice you to save itself. Do not let them. Final verdict. The 100 trillion debt is not a number. It is a tombstone for the post-1971 financial order. The Ponzi is ending. The auction is failing. The silent assassin is waiting in Tokyo. The math is inevitable. The margin call is coming. The only question left is, will you be the one paying it? But the debt is just the symptom. To understand why we are here, you have to understand the lies that got us here. Join us next time as we peel back the layers of the fraud.